hey, we've had a couple of good days in the markets. Now, I got to back up here for a minute and talk about where we've been to tell you where we are now. Because over the last couple of months, I've been writing about repeatedly in our newsletter about this declining pattern of prices that we've had, along with this support along this 200-day moving average. Now, that declining pattern, I talked about this on Tuesday, and discussed it as coiling a spring. We were compressing these prices more and more and more. And I said that on Monday, I said, we're going to break out most likely this week. And we broke out yesterday. And of course, that breakout, as I said, was going to lead to a push higher in prices, which is exactly what's happening. Yesterday and today, we've had good, strong rallies. We actually moved back above 2,700. Now, 2,700 was the 100-day moving average, and that's our key level that we've been looking for to take some of the cash. We'd raised cash previously this year, and we said above 2,700, that's going to be an opportunity to put a little bit of cash back to work. So we started that process today. We're going to finish some more of that tomorrow. But this breakout to the upside of this compression suggests that market prices could reach old highs, because technically from a compression, the move out of the compression, whether it's either up or down, is typically the size of the initial decline. So if the initial decline was from 2,800 to where we were at the bottom around 2,600, the rise back up should be the equal spike. So this should put us back up towards old highs. Now, it doesn't mean it's going to happen tomorrow or the next day. This could take a couple of weeks, but the market should start to work themselves back up higher. Now, that's the good news. The not so good news out of all this is that simply the market's not gone much of anywhere this year, and despite a lot of volatility here, we're about to move into the weaker part of this year. Plus, we've got a lot of stuff going on right now, as we were just talking about a moment ago, with what's going on with Iran, North Korea, Russia, China. There's a lot of things happening on a geopolitical front that could really upend the markets. Now, that doesn't even include things of what we're talking about economically. Economically, we're seeing weaker factors really come across the board. We've seen ISM manufacturing and services numbers come in weaker lately. We've seen inflationary pressure still remaining weak despite the rise in oil prices. But don't dismiss the rise in oil prices. Yes, it's great for oil producers and it's great for Houstonians. We love the fact we have higher oil prices. But the problem here is with higher oil prices, it's also a tax on the consumer. So as consumers have to pay more at the pump, it also detracts from their consumptive ability to spend elsewhere. And with consumers already heavily indebted, lots of debt, it leaves them little ability to continue to do their consumptive patterns to help promote further economic growth. So despite higher oil prices, which is should be translating into actual higher rates of inflation, we're just simply not seeing that occur. But at the same time, we are seeing impacts on producer prices as well as manufacturing having to deal with higher input costs. And the question begins whether or not they can actually pass that on to consumers. So there's a lot of things that are currently kind of piling up behind this market that may affect future earnings. And so I'm not saying that this is going to happen tomorrow or the next day. There is a risk right now that we're going to potentially have a little bit more trouble either later this year or potentially as we get into 2019, really starting to see some economic deterioration. So pay attention to all of this. This is important as we continue to look at that. Now, on the other front of this, and this is also something that is interesting but also should not be happening, bonds are moving lockstep with stocks. So the fact that when stock prices were declining, bond prices were declining. When bond prices are increasing, stocks are increasing. That shouldn't be the case. We should see money flowing from bonds into stocks. So on big rally days like today, we should actually see bond prices going down and yields going up. We saw just the opposite. We actually had a bigger percentage move in bonds today than we actually had in stocks. So that shouldn't be going on. So this is telling us one of two things here, is that either bonds have reached their peak and very likely the rally in stocks may be short-lived, which is one of the outcomes I did discuss. I said that even if we get a breakout of this consolidation pattern, this rally may be short-lived. So even though we're going to be adding some equity exposure here, A, we're not going back to 100% of target, and B, so we're going to keep some extra cash on hands, but B, we're also maintaining very, very tight stops. Now, I wrote about this week on our blog post, actually on Tuesday, and then again on Wednesday. There's a quick take on our website right now about this potential breakout, and kind of goes through exactly what we're going to be doing with our portfolios. Again, I'll be updating all this tomorrow, so if you go by the website, realinvestmentadvice.com, like I said, one of the best sites out there. If you haven't checked it out, you're missing out on all kinds of good stuff. But if you go by the website, click the subscribe button this weekend, I will email the newsletter to you. There's a link on our website for the newsletter. You can read it free every week. It has a 401k plan manager in it. It has everything that we're doing in our portfolios and how to manage your money better. But if you basically click the subscription button, it's free. Just put in your email address. I'll email you the newsletter on Saturday, and I'll update all this analysis for you so that you have a better handle and expectation about what to do next with your money.